Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
February 11th, 2026. Thanks for listening to the show. Year to date, the Nasdaq's down 0.6% before we opened. The S&P 500 up 1.4%. The Dow Jones Industrial Average up 4.4%. The Russell 2000 up 8%. The S&P Midcap 400 up 8.6%. Pretty interesting stuff that what worked last year is not working this year. Now, again, we're only a month and a half in, but are you willing to say that out loud like I just did? We're seeing Spotify downgraded today to hold from buy at Pivotal Research. They're lowering their price target to $420. It's a $476 stock. I'm interested in negative analyst outlooks as well as positive, especially if I'm owning a stock or thinking about owning a stock or once owned a stock. I want to see what's going on in their mind. So Pivotal Research lowered their price target to $420 from $875. That's a big downgrade. I'm going to get into the market numbers in a second. I just thought this would be a good way to change things up and how I approach every day with you all. Spotify delivered a solid fourth quarter 2025 result highlighted by record user growth, 751 monthly active users, up 11% year over year, 290 million premiums, up 10% year over year, strong profitability. They had 701 million euros in operating income, up 47% year over year. These numbers look great. So the analyst says, however, significant uncertainty on the outlook for premium music streaming amidst massive structural changes related to AI drove substantial long-term reduction in our monthly active users and our average revenue per user forecast, and a major reduction in our terminal value in our discounted cash flow valuation methodology. This resulted in a 50% reduction in our year-end 2026 price target. That's why they went from $875 down to $420. It almost sounds like there's a flaw in their Excel spreadsheet. There appears to be a path to success for Spotify. Numerous risks emerged from AI, drove these forecasts and terminal multiple adjustments. In the end, they believe that AI could shrink the opportunity in paid music streaming, perhaps substantially over time, with stock trading around fair value. They're reducing their rating from buy to hold as they await greater certainty on how AI will affect Spotify's business model. So, something that really stands out, and I think you should point this out to yourself and go, okay, I get where he's going at with this, is that in the last sentence there, they're waiting for greater certainty on how AI will affect Spotify's business model. We saw a little bit of that yesterday with investment advisor stocks like Charles Schwab and LPL Financial getting hit on a company named Altra saying, we're going to add new tax planning software that's AI driven into our investment advisor model. So companies that don't have that already added in got hit, LPL and Schwab. The day before, it was the same thing happening with insurance companies and how AI is going to help onboard clients and essentially, potentially, eliminate that advisor onboarder person, not the advisor that you're working with, but their secretary or administrative assistant who calls you up and says, okay, we need this, this, and this, and we need a signature here, here, and here, and we also need this by the end of the quarter, and give you all the information that you need. So let's move on through and let's take a look at the market numbers. So the big question, or before we move on through, let's say the big question now is, how hard is AI going to hit every industry? And Wall Street seems to be the focus in the second week of February. I love Wall Street. It's never boring, is it? So this morning, the markets opened higher, went into the red, and now are fighting for the green. The S&P 500 is up 6 points for the day, up fractions. The Dow Jones Industrial Average is up almost nothing. In fact, it's down 6 points, down 0.01%. The NASDAQ down 51, down 1/5%. Maybe that's a down day to you. It's not even 0.5%. It's less than 0.25%. The Russell 2000 down 19, down 0.75%. That's material. Let's take a look at Bitcoin down 3,111, down 4.4%, sitting at 66,349. I'm going to talk to Bitcoin. Not to Bitcoin. Hello, Bitcoin. It's me, Rob. Let's talk about Patrick O'Hare. No, I'm going to talk with Patrick O'Hare about Bitcoin in the second segment today. Plus, he gives his market outlook. The 10-year Treasury sits at 4.16%. Crude oil up today, almost 1.8% to $70. So there's a little bit of tension between the United States and Iran pushing crude oil higher. That'll hit airfares and it'll hit gas tanks. As Brent crude moves to $75 level, it becomes problematic around $75 to $80. Will the United States and Iran resolve? Or will we throw jets and missiles at anything that looks like a nuclear program in the near future? I don't have an answer for you. Gold's up 51, up 1% today, 5,082. Silver's up 3, sitting at 83.44. They seem to be like the winners of, wow, that's catchy, that's flashy. Gold and silver. And copper. Now, in the last 2.5 years, it was AI. I could argue that in the last 10 years, it's been Bitcoin. Now, the luster's coming off Bitcoin this quarter, last quarter. Is it for good, or will it be the pause it reflects? Because Bitcoin gave into AI, AI's given into gold and silver. Is this possible? I'll talk about that in the second segment with Patrick O'Hare. Let's take a look at the big picture on the markets as we've traded a few hours now. Solid January employment situation report shows 130,000 payrolls added. The big problem with the payroll numbers is that, yes, the number seems to surprise on the upside when we get it. But then the following 2 months of revisions downward tell the real story. And right now, it's those downward revisions that are the humbling part of our jobs market. Software and mega cap stocks are under pressure again today. Strength in energy, industrials, materials, consumer staples, and IT. Weakness in communication services, financials, and consumer discretionary. Shopify is down 11.5%. Ouch. Microsoft down 2.3%. Apple 11 down 6.8%. The big index that follows software, ticker symbol IGV. It's the iShares Goldman Sachs Software ETF, down 3.6%. Robinhood Markets down 12%. We'll hit most of these stories as this podcast unfolds today. $6 trillion. That's what we have in cash accounts and bank accounts right now. Opportunity is waiting for the stock market. That's one of the positives down the road. Lower interest rates due to the Federal Reserve. Positive down the road. Negative down the road is inflation due to lower interest rates down the road. So you have to count your flags and you have to keep an eye on these moving targets on what you believe in and what you don't. Job growth crushes expectations in January. The unemployment rate unexpectedly dipped to 4.3%. I was warned yesterday that the Trump administration says that these are going to be tough numbers because the number of immigrants that we've kicked out of the country, they're no longer going to show up in this. Didn't really happen that way. The employment gains were very narrowly focused on an industry basis. Healthcare accounted for 95% of the net job growth. That's not a great number. It's not a great data point. Vertiv shares up 17% after a blowout quarter. Organic orders increased 250% year over year, 117% from the third quarter. Data center market is showing robust momentum. That could lead to the picks and shovels plays gaining ground with names like Eaton included. Cloudflare up 13%, reporting better than expected results. Revenue forecast was above the street expectations. Baird upgraded the stock to a buy, equivalent of outperform. Cloudflare beat Wall Street's expectations and issued upbeat guidance as artificial intelligence hikes adoption of its networking and security solutions. Shares rallied last month on the popularity of Moltbot, with Cloudflare's tools providing a security and infrastructure base for the open source agent built on Anthropic's Claude. Anthropic's really getting in the news a lot right now. So the shares are up 10%. CEO Matthew Prince said the rise of AI and agentic tools that can carry out tasks on a user's behalf has driven more demand to Cloudflare's networking and security offerings. Global networking and cloud provider adjusted earnings of 28 cents per share on a $615 million in revenue. That topped expectations just slightly. But it was a strong guidance calling for revenue in the range of 620 and 621 million in the first quarter, ahead of expectations of 614. Under promise and over deliver. If that plays out, that's going to be a good beat. Micron shares are jumping today as the CFO says the company has started the HBM4 shipments ahead of schedule. The high bandwidth memory, Micron ticker symbol MU, up 5, almost 6%. On that news, this is the type of DRAM that's incredible for AI servers, and it's needed. So NVIDIA's up on the news as well. Demand for these components is so intense. It's running ahead of production. Finding willing buyers shouldn't be much of a challenge, even at the ever-escalating prices on memory. Lyft shares are down 15% after missing fourth quarter revenues and active riders. Consumers were really strong, so says the Lyft CEO. He got on CNBC to try to put some spin on these numbers. He sees no softness on the consumer side at all. Lyft accelerated bookings and record profits. The company generated $1 billion in cash. The big transition to autonomous vehicles is coming soon. The Super Bowl ride volume increased. So Lyft in the news today. Kraft Heinz shares slipped 6% after the packaged food giant said it's pausing its breakup plan, but gave weak 2026 guidance. This is one of those stocks that's in between me looking for income, looking for boring, and my kids looking for growth. I'm going to say that phrase more and more on the show. Is this a stock for my kids who are in their 20s? Well, they're in teens, but I'm going to invest as if they're in their 20s. Or is it a stock for me who I've got enough money to live till the day I die, and to give them enough money to live till the day they die? So I'm not really investing for growth or hyper growth anymore. I don't need it. I love it. I still find opportunities with it. But sometimes if I say this is for my kids versus this is for me, I'm in the growth and income phase. They're in the growth phase. They don't need the dividends that Kraft Heinz provides. Heinz is investing $600 million across marketing, sales, and R&D. To me, it's a boring packaged food stock that pays a decent dividend, but man, that equity is no bueno. Dick's Sporting Goods upgraded to buy at Baird. Analysts expressed optimism in the multi-year recovery of its Foot Locker brand and continued momentum in its core stores. I think Nike's the more sexy name in sporting goods as a potential turnaround. Is it something you should own? I don't know. It's how many stocks should you own in your portfolio of growth? Is Nike in that category? Its dividend isn't attractive enough to leave it in the income category. UBS raised their price target on NVIDIA today to 245 from 235 ahead of earnings in a couple weeks. That implies about a 30% upside from yesterday's numbers. Everyone's going to be looking at the revenue guidance going forward since they probably added back business into China. DuPont, better than expected earnings report yesterday. Mizuho ups their price target to 52 from 46. DuPont would be a name that I would consider for income, but not much else. Jefferies gives it a $59 price target, up from 51. An activist investor firm, Ancora, is telling Warner Brothers Discovery board it should reject Netflix's offer and side with Paramount Skydance. Ancora has built a $200 million stake in Warner Brothers. Interesting. That it's getting a little bit more dramatic. Let's talk Robinhood real quick. Then we're going to go to Patrick O'Hara. Then we're going to come back with all the big tech stories that are still out there that I haven't gotten to. Robinhood down 10% after the fintech app missed revenue expectations. The recent weakness in crypto markets weighed on Robinhood. Vlad Tenoff, who I met about 10 years ago at an investor conference when this was still a very private company, he said on CNBC this morning, the company is still very bullish on crypto industry in the long run. There was a lot of interest in the prediction markets after the NFL season ended. There's a lot of interest in the government shutdown prediction contract. Impact from AI is going to be positive. There are already people leaving California because of the proposed wealth tax. Total platform assets increased 68% year over year to $324 billion, with fourth quarter net deposits of $15.9 billion. That's 19% annualized growth. It's the 8th straight quarter above $10 billion. Transaction-based revenues increased 15% year over year to $776 million, driven by other transaction revenues of $147 million. That was 300% up year over year. Option revenues up 41%. Robinhood continues to show strong engagement and growth, highlighted by its 8th straight quarter of net deposits above $10 billion. The quarter was not spotless. The revenue miss stands out and largely reflects a sharp step down in crypto revenue, which is likely weighing on the sentiment. Net deposit growth also decelerated versus the third quarter, which may raise questions about sustaining its recent pace. Management sounded upbeat on newer growth projects like the prediction markets, which it believes is at the beginning of a multi-year supercycle. Prediction markets are basically a poor man's betting, so you can bet on the coin toss on if it's going to be heads or tails. You can bet on, will Steph Curry get over 22 points tonight, over 3 assists tonight? I don't like it, but it is a strong product future, and Robinhood is this one-stop app that does crypto, that does banking, it does credit, it does predictions. My kids like the one-stop app. Prediction markets were strong, but overall, a very mixed quarter, so says Mizuho. Barclays says Robinhood's fourth quarter came in softer than expected as lower take rates in options and crypto impacted transaction revenues, and lower lending in particular impacted net interest income. Piper Sandler said, bottom line, despite these short-term headwinds, which we laid out in our note last week, our long-term thesis remains intact. If we can stomach the volatility, Robinhood is the best way to play secular growth in retail trading and the closest fintech platform we've ever seen to achieving a super app status. Good. Agree with me on that. I don't own any Robinhood at this point in time. Citizens analyst said slight revenue shortfall for Robinhood markets, but better expense performance broadening business contribution. And a full roadmap should support strong growth again in 2026. They're reiterating a strong outperform. Not a strong outperform, but a market outperform. I got to get my semantics correct so I don't mislead you, if you will. Coming up, Patrick O'Hare from Briefing.com going to talk about current market conditions. He's going to talk about Bitcoin in particular. But I have an event coming up March 11th. 6:30 to 8:30. It's a Wednesday night in Lafayette at the library, Lafayette Library. Navigating Wealth in Uncertain Times Beyond the Noise. CFPStephanie Richman and Nathan Rogers, as well as myself. You can sign up for the event 6:30 to 8:30, March 11th at robblackshow.com.
Brought to you by EP Wealth. This is the Rob Black Show.
Joining me now, Patrick O'Hare with Briefing.com, a reliable source of domestic and international news that you can use. Mr. O'Hare, current market conditions, they seem to be changing week to week, even month to month so far in 2026. We're wrapping up the earnings season, the first one of 4 for the year. What do I find you focusing on right now in the second week of February?
Good morning, Rob. We're still focusing on earnings, of course. We'll get that rolling through actually through the end of February, even into early March for this fourth quarter reporting period. So we haven't given up on that yet, but focusing a lot on the economy, certainly today in the wake of the release of the January employment report, which was much better than expected from a headline standpoint. So paying attention to that and looking at it certainly in relation to the so-called pro-cyclical trade that we've seen winning out so far here in 2026, which features the outperformance of the small cap stocks, the value factor, and those more cyclically oriented sectors such as materials and industrials and energy.
Okay. With earnings season, it seems to be the total number is better than expected as far as earnings, companies that are earning better than expected, the revisions being higher. Is that a trend that you expect for 2026? And it's too early, but 2027?
It is a trend as far as that we would expect to persist. And I say that somewhat casually, to be honest, because the way that earnings seasons typically go is that you usually see companies report better than expected earnings. Analysts typically will lower their estimates as the quarter rolls out. So it's just a built-in bias to be overly optimistic at the start and then to get more data and then take things down. And then lo and behold, you get companies that come in and post better than expected results. That's the norm in terms of the reporting season. But I should point out what was unusual about this earnings season, however, is that analysts actually were bumping up their earnings estimates going into the fourth quarter reporting period. And not only have companies beat that initial estimate, I'm blowing it away in aggregate. We have a blended growth rate right now for the S&P 500 of 13%. That was projected to be only about 8% in early January. And in turn, the revenue growth is also exceeding expectations, up at 9% right now versus estimates that were closer to 6% when the reporting period began. We do have these tailwind, certainly. I've heard a lot about it, I'm sure, just as far as the fiscal or the stimulus of the tax refund component here that should be kicking in as we get into this end of this quarter and second quarter. And fortunately, it looks like we still have an okay labor market that's going to be supportive of ongoing growth in consumer spending. And with those elements in place, provided interest rates remain relatively well behaved, we should see the earnings estimate trend continue to work in the market's favor.
We live on the opposite coast of the United States at this point in time. You used to be based in Chicago, so you've got many years of being biased by the Midwest of the United States. Let's talk about those jobless numbers. And from my perspective, and you don't need to get political here, I'm a little bit not trustworthy of the numbers since President Trump's administration has basically told a lot of economic data providers from the United States government, we're looking for better numbers, particularly tied towards interest rates. So that, to me, is bleeding over in a cynical level into the jobs numbers. How much do you trust the jobs number, and is it important whether you do or don't in, I guess, the big picture?
Yeah, it's something that we have to take at face value, so to speak, because we know that the Federal Reserve is going to be cluing into this data and using it to drive policy decisions. I get what you're saying in terms of why there's room to question the numbers, but taking any partisanship out of the equation, let's just remember that the employment data is always subject to revisions, and
that's right. You
can see some large swings, and that doesn't matter if it's a Democrat as a president or a Republican as a president. We see it every year, and what all we can do, certainly as market analysts, is take the data that's coming at us. And I know there are some elements here or some concerns related to the seasonal adjustment factors. And it's a big economy, and it's not easy to measure it, obviously, with pinpoint precision. And these estimates are close approximations, hopefully, of what the actual picture looks like. But we've been able to rely on the data for many years, and we're not going to abandon it now necessarily. And you can see that the stock market isn't either. We've seen a reversal in trading action this morning, but the initial reaction was on par with what you would expect. This is a report at face value that suggests that the economy or the labor market is still hanging in there just fine. You have a low unemployment rate, you have real wages ahead of the rate of inflation, which is obviously good. And so you saw a nice upward open this morning, but that's been reversed maybe for some other factors that could even be related to how Bitcoin is trading again today.
Let's talk a little bit about Bitcoin. Which would you rather have your love give you, a Bitcoin this year and or spend almost $200 on Valentine's Day? I'm basically asking a question about the future of Bitcoin, not your marriage.
I guess I'm more of a traditionalist, I think. So I guess I'll take the $200 and have a really nice dinner.
Okay, that's fair.
But I'm sure there's many people out there that would still say Bitcoin any day of the week, especially given how much it's sold off here recently. But I think really what I'm driving at here as far as it relates to market action is that we saw a nice rebound off that 60,000 level for Bitcoin, and you saw also stock trading conditions improve at the same time. Maybe it was coincidence, maybe it was direct tie, don't know. But when Bitcoin had been selling off, you saw the tech stocks and a lot of the growth stocks obviously getting hit very hard, also tangentially because of the AI disruption worries. But when coin did rebound, you saw the whole market also rebound at the same time. But now we've got Bitcoin fading back again, and I'm just looking at an intraday price chart of Bitcoin relative to the intraday chart of the S&P 500. They're lined up pretty closely. And so when you get Bitcoin rolling back here, it obviously prompts concerns about forced selling again that just undercuts sentiment and can lead to just an inclination to sell first and ask questions later in the stock market out of a concern that you get a repeat episode. But yeah, we'll see what happens here. But the market has had a nice rebound, obviously, since last Friday. So one could make a case it was due for some consolidation anyway, and that perhaps you're even getting some selling into the news of the employment report, which corroborated what the market had already been pricing in, which was a pretty good economic growth outlook.
I'm not putting words in your mouth, but I think you said something along the lines of Bitcoin seems to be a risk-on asset, very similar to the S&P 500. Should we correlate that consistently going forward, or no?
I don't think so. I think
okay.
There's been such hot money in Bitcoin, a lot of momentum in there, and you can make the same case for the tech stocks and the growth stocks. And while the correlation has been stronger of late, I think it's more of a situational thing and not something that we would expect to persist, particularly if you get that speculative fever coming out of the cryptocurrency market, because traders and investors have other options to play now that maybe they didn't before as it relates to participating in the prediction markets. But you'll expect to see continued volatility in Bitcoin and cryptocurrencies for a long time, I'm sure. But as far as the correlation to the S&P 500, I don't think that'll be as strong moving forward as it has been more recently.
It's interesting to note because it seems to me that the retail investor is fascinated by what's shiny. 10 years ago, it was Bitcoin. 5 years ago, 3 years ago, it was AI. This summer, it could be hot IPOs with SpaceX, Anthropic, and OpenAI. It's always what's shiny that fascinates the retail investor. Anything that you're working on? We've got about 2 to 3 minutes left in this segment that you want to hit on for us today, sir?
Yeah, silver and gold have been pretty shiny of late.
That's right. That's right. Exactly.
I know. Yeah, exactly what you're talking about. And also, again, relates to some of that sucking sound you've been hearing coming out of Bitcoin. Probably some of that hot money's moving into that hotter market, which makes commodities markets kind of nuts. But you do touch on a good thing, though, Rob, about these upcoming IPOs and how that spigot might be opening up here, or it is opening up, but may start flowing really more fully with those massive IPOs that could come this year. And that can take capital away from other corners of the market, stock market anyway, as investors chase those few like shiny new objects that have great stories underlying their businesses. So we'll have to see if we get some type of like rotational element there. But it's also an exciting thing for the capital markets that you're getting more IPO activity. And so something that we'll be watching. And I think in relation to the big picture column that I post each Friday, will likely be revolving around this economic theme we've been talking about and discussing, and the importance of a solid labor market, keeping the U.S. economy on a nice growth track that's supported by higher levels of consumer spending.
Thanks very much. It's Patrick O'Hare, a reliable source of domestic and international news that you can use. I start my day every morning, and I'm talking 5 in the morning, 4 in the morning times, with his page one commentary. I end my week with his big picture. He is not a one-man show at briefing.com. There's a lot going on. Articles on special reports, ETF notes, the swing trader, which I looked at earlier this week, liquid momentum, there's economic calendars, there's news feeds on the minute by minute what's happening on Wall Street. So a lot going on at briefing.com, a reliable source of domestic and international news that you can use. That's Patrick O'Hare with briefing.com. He did an artful job when asked a fairly pointed political question. And he did a lovely job talking about the retail investor as well. Always good stuff. Patrick O'Hare, briefing.com.
This interview featured on The Rob Black Show is brought to you by EP Wealth. Learn more at robblack.com.
Looking at some of the top stories from today, the jobs report smashes expectations as payrolls grow by 130,000. But too much of that, over 90%, was tied to healthcare. So it wasn't exactly what we wanted to see. Growth in non-farm payrolls blew past expectations. Gains were narrowly based and concentrated in healthcare, a little bit in construction. Government continues to shed jobs, as did state and local governments. Healthcare and social assistance together accounted for about 124,000 of those 130,000 jobs. According to updated 2025 numbers, the economy gained a paltry 180,000 jobs for the entirety of last year. That was down from what was reported of 584,000. That's the slowest pace of job growth outside of recession since 2003. Learn to talk about estate planning and long-term care. It's been a journey with me and my spouse. It's tempting to lead with logistics, but that can feel like pressure. Ask things like, if you couldn't live on your own anymore, what would you want? That shows respect for people's autonomy. Don't ask things like, have you thought about assisted living or a nursing home? Focus on caregiving, not endings. Say things like, if one of you needed care, mom and dad, and the other didn't, what would that look like? Whereas you don't want to say things like, what happens when one of you dies? It's harsh, it's cold, it's not great. Learn to talk about money with your spouse, with your parents, with your kids. Ask about fears, not about conditions. Ask what worries you the most about getting older. Don't ask, are you scared of getting dementia? Ask, what have you already got in place? Don't ask, you don't have long-term care insurance, do you? That's expensive. One of my friends that I was speaking with over the weekend at the Pints and Portfolio, he shows up and we have a beer after everyone leaves. And I was going through his quick profile, and his wife wants to spend money now and he doesn't. They've got about $600,000 saved and he is 60. So it's fair to say that he has anywhere between 2 and 5 years before he starts tapping into his Social Security, because they don't have a great income. She wants to spend money now. He wants to not. They're not fighting. He likes to keep the peace, which I find to be, that's not as important as talking, keeping the peace. I understand love. I understand Valentine's Day. I understand sexual relationships between two adults. Many people want it more important than fighting. I get it. But the big question arises, what are they going to do when they're 60 plus, 70 plus? He was talking about going on one of his last vacations of his life, and when he was talking about it, it didn't sound great. His wife wants to go to Italy to have their kid visit a friend who moved away 3 or 4 years ago. The lodging might be free, but the flights and the experiences are not. So I'm all about experiences now, so I won't vacation with another family. I don't like it. I tend to find that if I vacation with another family, they look at their phones while I want to go out and explore. I don't want to stay in an Airbnb and play cards. I want to go out and explore. I want to see Miami at its finest, the finest restaurants, the finest beaches. I want to see the alligators. I don't want to sit around and play cards. You get the idea. Let's move on from realistically talking and expectations to make with people and retirement issues. Let's get back into stocks, the area that I feel probably the most comfortable in my life. We last led off talking about analysts and Robinhood. Let's go to Shopify. Ticker symbol is SHOP. It's down $13 a day. It's down about 8-9%. The pullback comes after the stock had surged roughly 13% last week. So lofty 68 times forward earnings. Anything with a PE over 40 is getting questioned aggressively. Companies without earnings are getting questioned aggressively. We are in a different part of the stock market mentality. Now we're moving actually into, and I mentioned this earlier in the show, let's question, what will AI do to onboarding of new clients in the insurance industry? What will AI do to the reviewing your taxes? It's not rocket science. It's just work intensive. And that's something that AI does well. How much do we trust it versus how much do we have to do a review of its insights? Questions are being asked right now. Be very cautious on how you approach investing. Shopify's results reinforce its position as a durable, globally scaled commerce platform entering the AI era with momentum. They saw sales up about 31%, rising payment penetration, explosive B2B expansion, early traction in AI-driven commerce tools such as Sidekick, Catalog, and the Universal Commerce Protocol, illustrating a company broadening both its merchant base and monetization levers. I would refer to it as a poor man's Amazon. Now, you may not like Jeff Bezos. You may not like Amazon. You may not like what they do. You may like Shopify's better at smaller merchants. I'm here to get you to retirement and to get myself to retirement. For me, I'd prefer to find Amazon when it's 20 to 30 to 40% off. At least if I were to say, okay, I'm going to own 5% in retail. Maybe I go 3% Amazon, 1% Shopify, 1% something else. But I like when the market pulls back names like Amazon, Microsoft, Alphabet, Apple, Meta. I like it when there's that pullback. And it comes. Wedbush Securities analyst Dan Ives, he thinks fears around the seemingly unfettered big tech capex budgets are unfounded, especially in the case of Microsoft and Google. He thinks the two hyperscalers are slated to spend around $300 billion on the purchases of property and equipment this year as they double down on AI infrastructure. He says both have already shown that they can turn that spending into revenue and into growth. So he's out there defending. And it feels weird because maybe 3 weeks ago he was out there promoting. Now he feels like he's out there defending. And he's out there a lot. So you're going to see him if you're watching Bloomberg or CNBC. Do you have a favorite CNBC personality? I'd have to think about it. I used to really enjoy just the way. I've referred to CNBC in the past as financial porn. It's not totally fair, but there's not a lot there. Do you love talking to your spouse until early morning sunrises? Sure, that's a lot. But when you start talking about financial porn, it's not as in depth, right? I find that a lot of the people that you see on CNBC are people that you are saying what you want them to say. And or maybe they're visually appealing to you. Or maybe they're smart and that's appealing to you. Oh, I wish my spouse knew about money. Hey, anyone who wants to talk to me, I'm around. I know about money. And I'm relatively attractive. I'm not unattractive. I'm not a troll. But yeah, how do you approach CNBC? I don't approach it with any seriousness at all. So music streamer and soon-to-be physical bookseller Spotify reported impressive fourth quarter results. They're sending shares up yesterday, but down today. It added 38 million monthly active users, a quarterly record that brought in its total to 751 million. Wall Street expectations are for about 744 million. I mentioned a downgrade earlier in the show. Revenue for the quarter rose 7% to 5.4 billion, which fell broadly in line with expectations. Its gross margins were 33.1%, new company record. They forecast an additional 8 million in net monthly active users for 759 million total. Streamer guided for 293 million premium subscribers in the first quarter compared to 293 million consensus expectations. They raised their U.S. subscription prices. Last week, we saw Pepsi, who sells things like Doritos and Lay's potato chips, cut prices. Do we often see that? Other than a company like a Walmart who lowers prices with rollbacks because they get better deals with the distributors of the food and product, you don't see a lot of companies cutting prices. Do you ever think Spotify will cut prices? Quarter over quarter active user additions, impressive 38 million. And we look at it on a bar chart, it's even more impressive. Spotify Wrapped is more than a way to let people know what you listen to. Did you listen to 11,629 minutes of Geese? Some people did last year. Does it help you sleep? Between October and December, Spotify added 38 million new users, monthly active users up 11%, paid subscribers up 10%. These are all good numbers. They unveiled a slew of features recently. One gives users the ability to exclude suggested songs. So in AI, you can say, you can do a prompt where you're like beach music. And it'll go through all the beach music, then look at what era you look like you're from, and it'll find beach music from your era. Let's talk about tax scandals, because it's that time of year. In 1990, tax collectors seized the assets of Willie Nelson. He's the bandana-wearing country singer. He owed $16.7 million. Nelson sued his accountants for mishandling his money. He ultimately settled for an undisclosed sum that didn't cover his debt. To repay it, he released a 25-song collection called the IRS Tapes, Who'll Buy My Memories, with all the proceeds going to the agency. The album pulled in $3.6 million. Nelson eventually paid off the rest of it. It's serious not paying your debts to the IRS, because they will come after you. Tronic, which is an Austin-based Texas robot manufacturer, closed out a Series A fundraising. Now, again, if you own NVIDIA, you love it for the AI, but you're thinking, what's next? It's going to be quantum computing and even bigger robots. So when you hear about a company raising $520 million, yes, some of it goes to the insiders. Yes, some of it goes to new secretaries and new software packages, but a lot of it goes to NVIDIA chips. Humanoid robot maker Apptronik got investment money from Google, from Mercedes-Benz, from AT&T, and from John Deere. Qatar's state investment firm QIA also participated in the fundraising round. There's a lot of money still pursuing new technologies. When it comes to AI, investors have made a habit now recently of selling first and asking questions later. You saw it with Shopify. You saw it with Robinhood. You saw it yesterday with investment advisors, the day before with insurance brokers. There's AI jitters. There's negative sentiment that's seeping into Wall Street giants. There's the software apocalypse that has been going on for a few weeks now. The AI is forcing investors to reprice entire sectors in real time. As promising as the new AI tools may be, much of the market's response looks knee-jerk and overdone. It's worthy of note. The sector performance in 2026 is showing you that AI is not the love affair of all love affairs. It is not the Valentine's Day push. So far, year to date, tech is struggling in the S&P 500, as is financials and discretionary. Healthcare is down as well. So the S&P 500 is down about 2.6%. But healthcare is down 3.6, tech's down about 8, financials down about 6, and discretionary. So taking a look at the S&P 500 sector performance, there's the maximum pull down, and there's the year-to-date return. The S&P 500 is close to break even, yet tech has had big swings down and is underperforming the S&P 500. Financials have had big swings down and has underperformed the S&P 500, as has discretionary. Now, what's been the big winner this year? Energy, materials, staples, things that we absolutely just definitively need, things that aren't affected by AI. Do you see what this theme is happening here? I do. So sell-offs in software and financial services, it happens. And it's not surprisingly so. In the face of uncertainty, investors are reaching for blunt instruments. They're dumping ETFs in broad baskets rather than attempting stock-by-stock judgments. Claiming that AI is raising entire sectors of the stock market feels a little short-sighted. Creates buying opportunities. I think a realistic view of AI is that it's accelerating. And the stock market is going to be more of a market for pickers in the short term, stock pickers, not like fruit pickers. Don't get me started on that. So here's a cool Russian startup, a company called Neiry, Neiry. They've equipped pigeons with neural implants. Now we know about Neuralink, which is Elon Musk's implant, and how it gets a quadriplegic to play chess or watch TV or write. Impressive, crazy impressive. Now, this company called Neiry is saying it doesn't hurt the pigeons, but it's equipping pigeons that essentially turns them into drones. And it says it doesn't harm them. Potential use cases of a pigeon with a Neuralink would be search and rescue, infrastructure inspection, and surveillance. Surveillance kind of sounds dark, doesn't it? This sounds like an episode of Black Mirror. Now, another fun business story today is General Galactic. They're aiming to turn water into rocket fuel, an idea that, according to Wired magazine, has been frequently discussed but never achieved. This startup, General Galactic, is going to put into orbit a 1.1 thousand pound satellite using water. And it's going to be fascinating to see what it does. That's going to be its only propellant. Could that get us to Mars and further in the future? Let's talk about big tech companies. They're spending their huge CapEx budgets. How are they doing it? Meta, Microsoft, Amazon, and Alphabet. They're all expected to increase roughly 50% or more Total of $600 billion of spending in 2026. Tesla, which typically spends far less than big tech companies, also plans to double their capex this year, but they're going to spend over $20 billion on 6 factories, namely the refinery LFP factories, Cybercab semiconductor, semi-truck, and a new mega factory, the Optimus factory. About $8 billion of that's going into compute, $4.5 billion into vehicles, $3.5 billion to build Optimus robots, $3.5 billion into batteries and energy. Alphabet's going to spend, well, they spent $91.4 billion last year. They're forecast to spend $175 billion this year. It's mainly looking at AI compute capacity for Google DeepMind. Meta spent $72 billion last year. They're looking to spend $115 billion this year, maybe $135 billion. They're building models that are being trained at Meta Compute. Microsoft didn't give formal guidance, so it's possible its spending this year, like its peers, will ultimately exceed analyst expectations. That would put it at about $116 billion this year, up from $83 billion last year. Apple is the weirdo here. Last year they spent $12.8 billion. This year it's going to go up roughly to $13.3 billion. Its data center is someone else's data center and someone else's CapEx. Interesting that they're letting the others go to war over this. And there's big questions on Wall Street of, is it worth going to war? To spend all that money for large language model build-outs that are going to be, some people think there's not that much difference between Anthropic's Claude, OpenAI's ChatGPT, and Google's Gemini, and yet maybe $1 trillion of spend in the near-term future. Wow. If they're commodities, it's how does AI affect the rest of the industries in the S&P 500? Not just the hyperscalers, who are not an industry per se, but they're part of tech or communications, depending on how you're looking at it. I have a lot of questions there. French wine and spirit exports just hit 21st century low. Boo. Tariff bottlenecks. I bring that up because we forget tariff. The big, beautiful tariffs. The Supreme Court still has yet to talk about those tariffs. They will soon. That is something that could cause calamity in the markets. Short term, long term buying opportunity? I believe potentially. But again, you're going to have to consult a broker advisor for taking action on any stocks ever mentioned on this show. One of the best things you can do is drop me an email, rob@robblackshow.com, or come to a live event and ask questions. At the live events, I tend to get the diarrhea mouth, and I tend to talk a little bit more than I should about things that I'm buying and why I'm buying it. Be careful, ladies and gentlemen. Valentine's Day spending is the 5th biggest holiday of the year. We're going to spend about $199.78 per person on gifts, dining, and other Valentine purchases. That comes out to $200 a month, which comes out to $2,400 a year. In 5 years, that's over $10,000. In 7 years after that, it's $20,000. In 7 years after that, it's $40,000. In 7 years after that, it's $80,000. 7 years after that, it's $160,000. So for your big weekend, I understand you're going to need a little loving. I know that's important. Just don't overspend, okay? I don't overspend because a lot of people, when they overspend, they go on credit card debt. And our credit card debt's now $1.28 trillion. It's the most expensive way to borrow at roughly 20%, which is the average annual percentage rate. 175 million people in the United States have credit cards. 60% of credit card users carry a balance. Boo! Ladies, if you're looking to replace your man who has a big balance on his credit card with me who has no balance, it's weird because when I say that, it's actually why people on LinkedIn are starting to hit up people that they've got job connections with because they know that they have jobs. Hey, you want to get a cup of coffee? Quickly turns into, hey, you want to get married and have children? That happened fast. Meta spent millions on Super Bowl ads to showcase their AI glasses. Then one guy gave it better advertising for free. 12 minutes left in the fourth quarter, a shirtless dude streaker. He was wearing Meta glasses. He jumped onto the field. He filmed the entire run in first person. Totally worth watching. Just do Super Bowl streaker or Meta glasses. He filmed the entire run in first person. You can see him evading security, taunting the guards. When he gets face-to-face with the Patriots receiver, Kyle Williams, who's coming charging at him, he drops like a fly. He's done this twice. same streaker. He wears some sort of advertising on the back of his skin. But I thought it was a pretty big ad for Meta glasses, and it wasn't. Just inadvertently. Thanks for listening. Don't forget I have an afternoon podcast coming up. And I do have an event coming up in March as well. The afternoon podcast is New Focus on Wealth. The event is 6:30 to 8:30, March 11th. Navigating in uncertain times beyond the noise of investing. Lafayette Library. Sign up at robblackshow.com. That's robblackshow.com.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.